Welcome back to the podcast, folks. I'm your host, Jared Johnson, and we are delighted and lucky to have Mr. Jim Bianco here with us. Thanks for joining us, Jim.
Thanks for having me, Jared. Look forward to the conversation.
Yeah, I think we've got some interesting topics to discuss. I'll just put this out there. There's a lot of hot topics that I think we need to dig into, but I'm always interested in everyone's kind of take on everything, and I would love to kind of hear your approach and kind of through your lens, how you see the economy and the markets and everything shaking out. But before we get to that, so you are the founder and president of Bianco Research, and you guys have been at it for a good couple of decades. Is that correct?
Since 1998, we're still here.
1998, man. That's I think I took my first trade. I began investing right in 2000. So time flies.
Oh,
but I think
you bought the bubble high, huh?
I thought Cisco has got to be a great deal, right? And
Yep. Cisco peaked at $500 billion in market cap in 2000, and it wasn't until 2023 that it got to $501 billion in market cap. So it only took you 27. Yeah.
It's Cisco, you bring up Cisco, that's a great example. And Microsoft, right? Microsoft is the backbone of so much. And I think people would be surprised to look at a Microsoft chart. I think it wasn't as bad as Cisco, certainly, but I think it was about 2016, maybe. Or was it 14, 15, 16, somewhere that it took out its .com high for like 15 years? Microsoft, of all companies, just really struggled to make.
Well, my favorite example back then was Amazon. And Amazon is a great example to show you how full of shit everybody is when they talk about investments. Amazon was $100 pre-split. Pre-split, it was $100. Bezos was on the cover of Time magazine as their person of the year because of the coming internet revolution in December of 99. By 2001, it was $6. By 2010, so it lost 94% of its value. By 2010, it was still $5. Or I'm sorry, it was still $50. It was still $50, half of what it was. Then throughout the 2010s and 2020s, it went from $100 to something like $3,300. So it went up 33x. See, you got to invest in these things long term. I'm like, you mean to tell me you're going to hold an investment and said, I've held this thing for 12 years. I'm down 50 to 60% after 12 years. I still think it's a good investment. Bullshit. If it goes down 2 days in a row, you think it's a mistake, let alone holding on to something that lost you half your money for a decade before it eventually works. That's why I say everybody's full of shit. They all know in hindsight what they would have done, right? But otherwise, if you really believe that, take every dollar of your net worth and give it to Cathie Wood right now. Because the reason you don't is because she lost 50 or 60% in 22 and 23, and everybody gave up on her. So, the inconsistencies, all investing is emotional. And basically they're looking at the emotion of it went from $100 to 33. And that's what they're really commenting on, but they're not realizing what happened before that.
I think to be the superb investor, it would be ideal to somewhere have like a decade-long coma. Like you put all your money to work, an unfortunate accident, you're out for 10 years, you come back, you've survived it, and now you're rich, right? Because
I'll go you one step further. There's an exact study that's done this. So Fidelity Investments owns, the National Financial Brokerage, right? Their big brokerage operation. That's just the name of their big brokerage operation. They did a big study of all of their brokerage accounts, and they found what retail accounts did the best, what had the best returns. And then they looked into the traits of retail investors that do the best. And do you know what the common trait was among more of them than any other common trait? They were dead. And they stopped trading their account, So I've always told active managers, if you really want to do right by your customers, maybe you should just die at that point, because that seems to be the thing that makes them do the best.
Oh, that is the truth. That is the truth. And it's so painful to hear these conversations, right? About, of course, Bitcoin or Nvidia or any of it, right? Oh, I own this at, $5 or 5 cents or 10, whatever, right? Listen, in 2008, I shorted everything. I made a lot of money. And then I bought everything at lows. And guess what I did after that? I let it all double and sold it all thinking I was the smartest person in the world as it proceeded to increase by 10,000%, right? So
Right.
it's so difficult. It's so difficult. And the emotions on both the positive and the negative side, right? Everyone panics when things go down and everybody panics when things go up, right? Let's take our profit. We'll never see it this high ever again. It's an interesting place to be. And on that front, obviously, and as I gave the disclaimer in the beginning, I'm going to have to talk about some things that have been discussed heavily, but are we going into a bubble? Is this time for people to get very defensive? Do we buy highs? What are we doing?
Well, there's two things to argue about a bubble. I mean, the problem, if we're going into, well, let me back up. Let's define the stock market as to what it is right now. And that is, and I'll use JP Morgan's Michael Kemblist, a strategist over at JP Morgan. They did a study and they said, here's 41 S&P 500 companies that are AI related. So it's the Mag 7, which we all know, some other AI companies, a couple of power companies, maybe about 6 or 7 power companies that feed AI, and a couple of capital equipment companies, 41 of them. That's 8% of the S&P. They're currently 48% of the market cap of the S&P. So let me start there. Let me start there. The argument about diversification has been turned on its ear, because if you buy an S&P 500 index fund, half your money's tied up in AI right now. Now, if you go back and you look at those companies since, and I'm going to pick a specific date in the past, November 29th, 2022. That's the day that ChatGPT became aware. That's a Skynet reference for you right there. And since that date, those 41 companies have accounted for 75% of the gain in the S&P 500. The other 459 companies have accounted for 25% of the gain in the S&P 500. I'll give you one last statistic, and then I'll tie it together. This year, those 41 companies through last Friday, the last time I updated it, they were up 29% this year, those 41 companies. The rest of those 459 companies are up 7.5% this year. The bond market, according to the Bloomberg Aggregate Index, is up 7.3% this year. So what am I trying to argue here? If you take the stock market and you say, here's AI, let's put that aside, right, for a second. The rest of the stock market, everything that's not AI related, is giving you bond market returns around 7 or 8%. Now, normally 7 or 8% is not a bad number to get. But in this environment, people think that that zero is a 20% gain and that we have to be getting something more than that. So the rest of the market has just kind of been churning along at an average kind of pace, nothing special. You could have put your money in the bonds. You would have gotten about the same amount of return in the bond market as you would have in those 459 companies. The other 41 companies are booming through the top of the roof. They are not only responsible, for 75% of the gain in the stock market. They're responsible for over half of the CapEx, capital expenditures in the S&P 500 companies. And according to Jason Furman at Harvard, I'll use his statistic. They account for 1.1% of GDP growth. Overall GDP growth is 1.2%. So they're basically accounting for 92% of the growth in the economy. Now, you could argue, well, that's why you have diversification, because you didn't know that these companies would go up. Fine. When they go down, all the other companies could be doing great. You're getting pulled under the water with them as well, too. And so everybody's got an AI bet right now, whether they want it or they don't want it. We're all tied up into this thing, whether you talk about the economy, the bond market, or breaking out the stock market right now. So what's the stock market telling us? The economy's okay. It's nothing great. It's nothing terrible. 7% is an okay kind of year. I'm talking about the non-AI companies. And we've got this boom going on in AI. Is it a bubble? Getting back to your original question. I guess the question is, what is the definition of a bubble? I would define a bubble as buy these stocks. You're going to make a lot of money really fast. You won't know when the high is, and you'll give most, if not all of it back before you get out. That's usually the way a bubble works. If the bubble is, no, buy these stocks, I'll see signs of a high and I'll get out, walk away with a lot of money, then why aren't you as rich as Elon Musk if you could time the market that good? The fact is no one can. So you buy these stocks, you can make a lot of money. You're going to feel really good. You're going to wake up one day, they're going to go down. You're going to say, no, I still believe. You're going to run it all down your leg. And then before you know it, it's all gone. That's how a bubble works. So we're in the phase of everybody's making a lot of money really fast. Now, the question is, can everybody really get out? And of course, some people listen to me go, yeah, that they'll give me outliers. Some guy over here in Southern California shorted them and made a lot of money, or some guy over here in New York, sold the top and walked away with a lot of profit. Yes, and 300 million people didn't. And they're going to wind up losing a lot of money. Just like somebody always wins the lottery, but it's not me and it's not you and it's not going to be anybody that we know anytime soon.
It helps, as we said earlier, to be the best investor. Probably not being alive is good.
Yes.
Or the alternative is living forever, right? Because if we're going to ride this market and say it corrects in a massive way, it could be a while. Because for some of these stocks to recover, the typical market cycles, right? Trees don't grow to the sky and most things don't go to zero. Now, there will be some consolidation in the AI space for sure, right? Everybody just throws AI on their name. And so there's going to be plenty of those outliers that go bankrupt, get consolidated, whatever ends up happening. Our big players sitting on a lot of cash, have a lot of money, have a lot of resources. But it could be a long haul taking out current highs if there's a dip. How do we, so if everybody that owns an index fund is about 50% exposed to the AI trade, how do people play that to lessen their exposure?
So two things. To go back to the first half of your question, I'm of the opinion, I've always said this, that a bear market in stocks is time, not price. In other words, what I mean by that is the stock market peaks, it sells off, but it always comes back. Correct. It always does. But the question is it going to take 26 years like it did after 1929? Is it going to take 14 years like it did after 2000? Because as you pointed out, we had to go almost to 2014 before we took out the 2000 peak. Or is it going to take 5 months like it did earlier this year or like it did in 2020? So that matters because where are you on the risk spectrum? Now, a reality of life is the over 60 crowd has most of the money. Okay, that's the boomers. Yes, but in 20 years, it'll be the Gen X's, and in 40 years, it'll be the Gen Y's. It's always the over 60 crowd with the money. If you tell the people with the money, the market always comes back, they'll say, yes, but if it takes 20 years or 14 years, I don't have that much time to wait until I get back to my old high. If you're 35, you could be like the Reddit degens right now, and they want the stock market to crash because they want to buy cheap prices because they want to hold it for 30 years. The problem with that argument is they don't have any money or they don't have enough money. It's that's over 60 crowd that does. So I think when it comes to investing, when it comes to a bear market, you've got to put yourself into the proper risk tolerance argument. How do you feel about a 10 to 14 year period that the stock market doesn't make an all-time high? Look, if you're 64 years old, you might not like that because I like where my life is now. I don't want to wait 10 years to get back to this point. And when I'm 74, 75, because I don't have much time then after that. If you're 40, you're fine with that. So that's kind of the first thing you want to start thinking about when it comes to, investing is that risk aspect of how you are, where you are on the spectrum. And I would say that there's a lot of people that are of the opinion that have got their risks all backwards. And I'll give you one quick anecdote. I was listening to an investment podcast back in April. Remember Liberation Day, market got cracked really hard in the first week of April. 74-year-old woman comes on the podcast in tears, in absolute tears. She said that she had to take, because at 73 or something like that, you have to take your mandatory distribution on your 401ks and basically at that point, you got to start paying the taxes. So she had her tax base set at a very high level. And then the stock market, all those tech stocks, we didn't call them AI stocks in April. We were still calling them tech stocks. They sold off about 20 or 30%. So she got a big tax bill. She lost a third of her investment, and she was in tears because it like halved her net worth at that point. And all I kept thinking was, and then they asked her, what do you own? I own Nvidia, I own Apple, I own all of these other things. I'm like, what are you doing with these things at 73 years old when you're right at the point of distribution? You should be in 1 month bills is what you should be in. If you haven't made your money by 73, you are either, now is not the time to be pressing the bet, unless your name's Nancy Pelosi. That's an exception to the rule. But now's not the time to be pressing your bet, trying to say, God, I got to get one more double out of this market before I die or something like that. But we're back to death here with investing in death.
Investing in eternity and
death. Yes, exactly. So if there's a takeaway from this podcast for everybody, it's to send hemlock to your investment manager, because then you'll get really good returns. But yeah, so that's at least, on the risk spectrum, that people need to understand where they are on the risk spectrum. A bear market is time, not price. Ask yourself a simple question. What if the market's peaking right now? What if it takes 10 years before it makes a new high? Markets always come back. The question is, how long does it take? What does that do for your lifestyle if it takes a decade? Like I said, if you're 40, it's a very different question, a very different answer than if you're 60 or 65. And the 60 to 65s, they definitely have all the money. Now, to the second half of your question about AI. And this is where I'm going to make a comment now, going to go off in a little different direction, make a comment about what's happening with the AI stocks. You pointed out, if you get associated with AI, your stock goes up. A lot of people, especially on Wall Street, I think are correctly saying most of the AI companies are not, stupid valuations. Maybe Palantir is, and a couple of others are like really, 250 times next year's earnings or something like that they're really stupid valuations. Maybe they're justified, maybe they're not. But most of them are trading at a forward PE. That's, Wall Street's estimate of next year's earnings divided by the stock price at around 40-ish. Now, for high growth, high expectation companies, 40 is not, it's high. I don't want to say it's not high, but it's not out there. It would be out there if you were talking about consumer cyclicals, or, if you were talking about energy companies or financials. A 40 PE would be way out there, because you don't expect them to grow as fast as you would expect those technology companies. But what makes it, get you to 48% of the stock market is involved with AI, is that it's every company is priced at a 40 PE. In other words, every company is priced as a winner. And I'll go you one step further. If you look at the Mag 7, what's the worst performer in the Mag 7 year to date? It's Apple. Apple's up, when I looked at it a couple of days ago, it's up 8% for the year to date. What does the Apple have that the rest of them don't in the Mag 7? No AI strategy. It's kind of sitting there on its hands, figuring out what it wants to do, and the market is punishing it. So the market is encouraging you to lie to me. Tell me you're in AI. I'll pump up your stock. And the problem is, not all of these companies can wind up being winners all at the same time. Some of them are going to lose. We know from the 2000 period, right? We pumped up all the stocks, and we had a pets.com that, famously advertised in the Super Bowl in 2000. And by the Super Bowl of 2001, it didn't exist anymore. There's only one other company in history that's done that. And that was FTX, during the dot-com bubble in 2021. And then in 2022, it didn't exist. It was a big advertiser with Larry David in the 2021 Super Bowl. And then by 2022, it didn't exist. So there's a history of fast-growing new companies of advertising in the Super Bowl and not existing a year later. And so that's what happens, is that all these companies are priced to win. Now, two other quick things about this. We've seen this throughout history, because if you go back to 2000, when we had the infrastructure build, we're having the infrastructure build right now of AI, right? The NVIDIAs, we're talking about building data centers, we're talking about powering data centers and the like. Well, we had this in late 99 with Cisco, as we've talked about before, with JDS Uniphase, with Global Crossing, and they were all priced as if everybody was going to win. There was no limit to anything. Global Crossing by 2000, without the name, if you're not familiar with the company, the name implies what it did. It laid fiber optic cable over the oceans and around the world. Yeah. They, by 2000, laid so much fiber optic cable that we will never use all of it throughout the rest of humanity. That's how far we overbuilt it. Is there an example of that in history? Yeah, in the 19th century, the most probably what's happening with AI, the last time we saw like half the stock market be tied up in one theme might be the late 19th century in railroads. What happened there was every railroad company was priced to win. Every track builder was priced to win. Anybody that had anything to do with railroads was priced to win. We laid so much railroad track by 1900. That was the peak year of railroad track in this country, that a lot of that track was only used one time, the time they came and dug it up. That was the only time they ever used it. And so
this is such a theme, though, right? Because I mean, as you talk about this overbuilding and everything, I mean,
this is AI. This is AI is what's happening.
How many trillions are we pumping into these data centers? Do you see?
And I'll conclude by bringing it back to AI. And Jeff Bezos made this comment maybe about a month ago. And he basically said, what happened in the .com bubble was we priced everybody as a winner. We so overbuilt it. And then we had the crap out from 2000 to 2020, from 2000 to 2002. The NASDAQ fell like 78% from peak to trough at that point. And Bezos kind of quipped, he wanted to thank investors because they destroyed their investment horizons, but they left the world, they left humanity with the internet, right? Because you built out the internet, you left the rest of us with the internet. And his implication was, I want to thank investors for the AI, because when you crap out and live the 80% correction, you'll leave the rest of us with AI. So thank you very much for doing it, And so that's that's what happened with railroads, right? When we had the bust, everybody's thank you very much. Even though we dug up a bunch of track, I live in Topeka, Kansas, and now I can get to Chicago in 1902 because there's a track that goes from Topeka to Chicago because you guys so grotesquely overbuilt everything. Thank you very much, even though I didn't invest a penny in any of that. And that's where we're going to be. By the way, to put a flip side on that, what recovered the market starting around 2004 or 2006, and the market started recovering, had a little hiccup during the financial crisis. I'm talking about TAC now. Was now you had the infrastructure build, overbuilt, correction. We're having the infrastructure build in AI. Yeah, we're probably overbuilding, and there's probably a correction coming somewhere. I don't know if it's next month or in 3 years or somewhere there's a correction coming. But then Bezos said, you left me with the internet. The question was, what do I do with this internet thing that you left me with? Well, then we invented business plans and companies to use the internet. Facebook, Google, eventually things like Airbnb and Uber, companies that said, now that you've given me this tool, I'm going to build a whole business plan around it. So we're in the infrastructure build of AI. We're going to overbuild it. It's going to correct. We're going to have a bunch of empty data centers that, are with tumbleweeds running through them, but we're going to be left with a viable AI. And then we're going to ask the question, what do I do with AI? And then there will be another level of companies that'll come. That'll be the content companies. Now that you've given me this tool, I'm going to build a company around it to do things and sell you products and services associated with AI. The problem with that content company thing, as a friend of mine quipped to me once, he said, the founder of those content companies for AI, they're probably in 7th grade gym class right now. So we got to wait a little while longer before they eventually get around to making those companies. But they're coming. They're coming here fairly soon. We got to wait
Could,
till at
could
least they're like a freshman or sophomore in high school before they start those companies, right?
could we turn these data centers into like, because we need more Costco locations. I mean, they're going to be big
Right.
warehouses, right? I mean, I need to buy a canoe a little more conveniently, but that's
But
that's
we can have indoor rivers too, so you could canoe through them as well. Yeah, I mean, but see, the problem is, you're right. Is it a race to insanity with a lot of the build out that we've got and the numbers that we have? It's virtually all of the economy. I also saw a statistic. I saw a statistic online from somebody who I respect, so I assume it's credible, that upwards near 70% of construction workers in this country are now working on data centers. Whether you're talking about contract, you talk about,
yeah.
laying floors or putting on roofs or putting in the plumbing or whatever, that it's an enormous number. But see, the problem is, go back to the Apple example, right? If you don't play, you lose. And then the one other example I'll give you is looking at the 2000 period. How do you get this overbuilding? Because, and I'll quote Sam Altman, who's the founder of OpenAI, in a second. Everybody looks at a deal. I'm going to build this data center here with this much power usage and this much output. And I get a bunch of investors from Wall Street that are dying to get into this. And they look at this deal and they say, it makes sense. And let's invest in it. And they might be right. And then there's another deal that makes sense, and another deal that makes sense, and another deal that makes sense. But nobody ever says, do all of them collectively make sense? And the answer is no, because nobody invests in all of them collectively. We only invest in one of these deals. So Sam Altman, in an interview about 3 weeks ago, addressed this. And I'll summarize in my words what he said. Oh yeah, AI is overbuilt. AI is overhyped, and it's going to crap out big. But not me. I got the deal that's going to be the good one. Good luck to you with your deal. And everybody seems to be saying that right now. Yeah, it's overdone. It's overdone, but not my deal. My deal's the good deal. That guy over there, he's got the suspect deal. And so that's kind of where we're at. In other words, what I'm trying to argue is, you're talking about railroads, you're talking about banking in the early 19th century. That was another big bubble too, when we invented, the modern bank. Whether you talk about railroads, whether you talk about radio in the 20th century, you're talking about television in the 40s and the 50s. You're talking about the advent of the mainframe computer in the 60s, the personal computer in the 80s, or the internet in 2000. This is a pattern we see over and over again with new technology. We price everything to win. We massively overbuild it. We have an infrastructure phase. Let's just build mainframes. And then, we overdo it. And then we have a correction, 66 to 68. Then we say, okay, now we got all these mainframes. What are we going to do with it? And then the programmers come along and say, hey, if we do this, we could, put a man on the moon. And we did in 1969 and stuff, and with an IBM mainframe. And so that is the cycle that we see over and over again. And Bezos is not wrong to say for society, it's not a bad cycle, because you and me, we'll assume we're not invested in AI, just for an example. We'll just sit here and watch it along for the ride. And what you're going to leave me with when the investment wreckage comes, you're going to leave me with AI. So thank you very much for doing that. And it'd make everybody's life better.
Thank you for that. Thanks for the AI. Sorry about your retirement, because it's gone. So
but you made my life better. So I'll buy you a beer next time I see you in the bar.
Everything's great. Now, if we compare, I think the markets bottom out, and these big sell-offs and the wreckage happens, right? And they tend to bottom out for longer, or actually for shorter periods of time, as you mentioned, right? We saw, the dot-com was the bottom really was kind of end of 2002. We had this kind of 2-3 year bottoming process. We had kind of this like year and a half bottoming process in 2008. And then it's just gotten exponentially shorter since. Any dip has been bought aggressively. Now, if we tie into that, in 2000, again, that was early on in my investing career, but I don't think the Fed was doing a lot, right? They weren't trying to rescue anybody. They were saying, dumb choices, enjoy your life. And then by 2008, they said, okay, we're going to launch TARP. This is a mess. We have to do something, right? And so now there's this Fed put that, of course, that's been on and off the last year or so. And everyone's saying, is the Fed put still intact or not? But the thought that the Fed is there to kind of rescue these crashes, if the AI bubble, not if, because I think it's pretty well established that when the AI bubble has a correction, the AI force moving forward has a correction, could it just be a short one? Could the Fed ignite animal spirits enough to rescue the wreckage from ultimately being what 2000 was, and certainly anything before that?
I'm going to answer the question, probably not, and I'm going to explain why probably not. But first, I'll point out, you're right. We went from 87 to 2008. The Fed wasn't really involved, and then they got a little bit more involved. By 2020, the Fed was buying ETFs. In the spring of 2020, they actually had a special purpose vehicle that they were SPV with the Treasury, that they were buying ETFs to try and support the market. Now, they were corporate bond and high yield ETFs to try and support the corporate bond market. But yeah, that's how far we've come right now, that the Federal Reserve Chairman is now the Chief Investment Officer of the United States. He's not the Federal Reserve. He's in charge of returns, is what his job is. Why we pay so much. Yeah, exactly. He's in charge of returns, and that's why we care so much about him. So why did I say probably not? Because in all of those other examples, whenever they were printing money and buying up either ETFs or doing TARP in 2008 or whatever other things that they needed to do, there was no inflation. And they couldn't get inflation above 2%. If you don't have inflation and inflation is not moving, man, you could just open the window and throw money in the street, and it won't raise prices. But something happened in 2020, the COVID shutdown. And I've been arguing that the COVID shutdown and restart of the economy is singularly the most important economic event of our lifetimes. It is not the financial crisis or the 87 crash or whatever else you might want to think would qualify for that. Because so many things about our economy and our culture and our markets changed after 2020. I've been calling this the post-COVID period. I'll give you a couple quick examples. Remote work. Before COVID, the total number of people that was doing remote work, there's a bunch of economists at Stanford University that have been studying remote work for many, many years, was about 7% of the workforce. Remote, by the way, defined is you get paid to do your job, not in a central location. So not at a hospital, not at an office, not at a school, not at a site. You get paid to do it somewhere else. If you do it every day, it's called remote work from home. If you do it 1 to 4 days, it's called remote work. Just so everybody knows what the definition of what remote work is. 27% of the workforce is now remote. It was 7% before COVID. Half the jobs in the United States cannot be done remotely. A surgeon can't be remote. A fireman can't be remote. A construction worker can't be remote. So really, of the people that can be remote, it's over 50%. And that has put a lot of power into the hands of labor and taking it away from management. And you see this all the time. Microsoft recently had a town hall where they had to basically, call off the prison riot because they were trying to get everybody back into the office so many 4 days a week, and they were rioting that they didn't want to go back 4 days a week. And so this is the power workers have. I'm going to quit if you make me do it. And I can find another remote work job and I don't have to move. And that's why I've got so much power. So that's pushing up wages. Deglobalization, tariffs are definitely, in that camp. And so what I've been arguing is, you sum it all up, we are 5 years past the shutdown and the inflation rate is still 3%. It is 3% is, for those that are not steeped in this stuff, that is an unacceptable number. And I'll give you an example of how it was unacceptable. We're recording 2 days after the New York City, New Jersey, and Virginia elections. And all the exit polls said, what did people vote on? A majority of people said they were not voting on Trump. It was not a referendum on Trump. The majority of people said they were voting on affordability, which is inflation, which is Mondami says he's going to give me a free bus and he's going to make city-run grocery stores. Is it going to work? I don't know if it's going to work, but he's at least saying he's going to try and do something about it. And I can't afford anything because prices are too high, because from 2020 to 2025, the cumulative increase of inflation was 25%. So you need $125 today to buy what cost you $100 5 years ago. So it is this inflation. So if the Fed wants to say, here's the AI bubble, and we're going to, crank up the printing presses and try and save the stock market, the fear you're going to have this go around is you're going to create inflation and you're going to produce confiscatorily high interest rates. And that's going to change the equation. In other words, I could have maybe said this whole thing in one sentence. You could get away with it if you could get away with all the money printing you want to get the stock market back to an all-time high if you don't have inflation. But when you do, and we do, and we're in a post-COVID environment, and I know everybody's like, what about technology? And AI is going to be deflationary and all that other. Well, it isn't now. And I would argue there's lots of other reasons why. First of all, AI is not developed enough yet to be deflationary. Maybe it will in 5 or 10 years. Maybe it will in 5 or 10 years, but it isn't yet. But without that, if all you're going to do is say market wobbles, print, and inflation goes up and interest rates soar, it's going to be worse. You're going to have a stagflationary bust in the economy. So you can only get away with it when you don't have inflation. From 2000 to 2020 or 2022-ish or so, we could do it because we didn't have inflation. But when you have inflation, you turn on the printing presses and it's going to make everything worse. And I think that's the risk you face in the next downturn. They cannot print their way out of it because they wind up making it worse.
So to wrap up this very interesting, and I've loved your points of view on all of this. You're the Fed chair tomorrow. What do you do?
So, the old W.C. Fields line, any club that wants me to be a part of, I would immediately resign from, right? So if I was the Fed chair, the first thing I would do is immediately resign. No, I'm just, what would I do if I was the Fed chair? I would lean on a statistic that's been out various times in the last year and a half. A poll has come out and said that the public was asked, would you trade off a 1% increase in the unemployment rate if it meant stable to lower inflation? And all of a sudden now the public is voting 75% yes. In other words, inflation impacts about 100% of the population. Everybody gets impacted by it. I would even argue Elon Musk gets impacted by inflation because it raises the cost at SpaceX and Tesla, and it makes it harder for him to do his job. Sure. He's not going to go hungry because inflation goes up, but he does want to try and produce results for investors, and it makes it much more difficult if you have inflation. But a 1% rise in the unemployment rate, I hate to be crass about it, 99% of the public's not affected by it. 1% of the public is devastated by it. The point I'm trying to bring up with this is we grotesquely underestimate the impact of inflation. If I was the Fed chairman, I would be trying to point out how devastating inflation is and how interest rates staying at a 5-ish handle or so was fine. It was holding down inflation. It was trying to bring it back down. The stock market last year was still making new all-time highs when we had 5% interest rates. It was making all-time highs this summer before we cut rates twice. Or as Charlie Biello at Creative Planning, when he puts out his tweets all the time, stock market at an all-time high, gold at an all-time high, M2 at an all-time high, crypto at an all-time high, housing at an all-time high, this at an all-time high, that at an all-time high. So what problem are we trying to fix here right now? And that's what's that?
Let's cut rates. Everything all-time high.
Yeah, let's cut rate. Yeah, what problem? Yeah, I jumped ahead. By cutting rates, what problem are we trying to fix here? And so I would be of that opinion if I was the Fed chairman. What are we trying to fix? Everything's at an all-time high. The Fed operates through the financial channel. What does that mean? That means we as the Fed, when we want the economy to grow faster, we try to excite financial markets. And when we think it's growing too fast, we try to rein them in, is what we're trying to do. Are they not excited enough that we need to give them more steroids in the form of cheaper money to go up? That's the way I would be arguing it. Now, I used to think, even a week ago, I would have been a lone voice in that room at the Fed. But now I'm finding out that Schmidt at Kansas City, Hammack at Cleveland, Logan at Dallas, these are the Federal Reserve presidents, and maybe a couple of others pretty much are in line with my view. Now you've got other ones on the other side headed by Stephen Mirren and Chris Waller that don't share that view. So there's a wide diversion of view, but I would probably be more towards that camp right now.
Leave rates, let markets continue on with what they're doing.
I'll reiterate again. What problem are we trying to fix by lowering rates? And let me anticipate a question. Is somebody screaming at me? Mortgage rates, affordability for homes. The problem there is, if you cut rates, let's assume that long-term rates follow down and mortgage rates come down. That's not always the case. That short-term rates could go down and long-term rates could go up. That exactly happened last year when they cut rates. But let's assume that mortgage rates go down. What happens? What happens then? The average home price in the United States is $414,000 right now. The average monthly payment, when you figure in mortgages on an 80% more loan and everything else, about $3,500. So you cut rates and you say, okay, so the monthly payment goes down. I'm just making up a number. It goes down to $3,200. That should make it at least somewhat more affordable for some people. What do you think home sellers are going to do? They're going to raise their price, and you're going to be right back to $3,500 a month. You're paying $3,500 a month to buy a home. Whether it's more to the homeowner and less to the bank in the form of mortgage interest, or it's less to the bank, or vice versa, less to the homeowner and more to the bank in the form of higher mortgage interest, you're paying $3,500. You are not going to fix the affordability problem with lowering mortgages. You're going to fix the affordability problem with more homes, by building more homes. The problem is, everybody says, yes, we should build more homes. Yes, and I would like a contractor to tear down the house next door to yours and build an exact version of your house next door to you, only better. And you go ballistic because you don't want that competition. You want somebody else in another neighborhood to build a home. If you want into my neighborhood, you got to buy my overpriced house. This is how we got into this problem in the first place, is we've got too many land use and building zoning laws and everything else to restrict the amount of production in the United States. And most of that's state and local anyway. It's not federal. It's not a whole lot that Trump could do about that. So I don't think, so my point is, cutting rates to bring down mortgages is only going to make rich people that own $414,000 or higher houses richer, because they could raise their offering price more. That's all you're going to wind up doing by cutting rates.
Markets are always the most entertaining place because somehow they find a way to work out these situations, and it comes with a little bit of pain. And at some point there's got to be some pain, but here we are, highs
right
on most everything, and we're watching and waiting.
And as far as the pain goes, I think, everybody also has an attitude that, oh my God, this is the last chance I've got to make a lot of money. I blew it. And I think that's why we've got this insane AI bubble going. Maybe I did kind of answer the question by calling it a bubble right there. Is I missed crypto. Maybe I go back. I missed tech in 2000. I missed the rebound after the financial crisis. I missed buying Bitcoin at $200. I missed doing this and doing that. I'm not going to miss this AI thing, is what I'm going to do. Because you're acting like, because if you miss the AI boom, there's not going to be another one after it. Sure there is. It's going to be the content boom. And the content boom is going to be, like I said, when you leave us with AI, what kind of business can I build with AI? It's not going to be Google and Microsoft and Amazon and Meta that are going to build that business. As I said, it's going to be the guy in 7th grade or gal in 7th grade gym class. And they're going to come up with a brilliant idea, just like some kid in his dorm room at Harvard came up with an idea called Facebook and stuff. So it's going to be something like that. And there will be opportunities to invest or to play in games like that. There's always going to be another mega bubble behind the next one. So don't worry. Yes, we'll have a sell-off. We'll be left with AI. The sun will shine again after some dark, cloudy period. You don't want to wind up making yourself miserable by overextending yourself and ruining yourself in that downturn. Because, like I said, the urgency I hear from people is man, if I don't make it with the AI thing, or if I don't make it with owning Bitcoin on its way to $1 million or something like that, there won't be another chance I'll have to do this again. Yes, you will. There'll be another one, and there'll be another one after that. But what you want to do is you want to be in the game for the next one. You don't want to kill yourself playing on this cycle so that you're unable to participate in the next one.
Yeah, you gotta survive. It's
Right.
The old saying of staying solvent longer than the market stays irrational. So we got to just stay on that boat and ride.
You asked me about my business, and I joke. We started our business in 1998, so we've been around for 27 years. And people said, "How am I doing?" And I said, "My doors are still open." And I got that idea from a guy. A restaurant in my neighborhood, and I got to know the owner of the restaurant. And this was many years ago. And I once asked him, "How you doing?" And he said, that 90% of restaurants that open close within their first year. We just celebrated our 2nd year of being open. So that's how we're doing, right?
We're breaking cycles.
Right. So I've been around for 28 years. So that's how I answer the question.
So far, so good. Well, That's great. That's great stuff, Jim. I appreciate you being on the podcast. I think you have some great points of view. Tell our listeners where they can follow you and find out more about what you do and your insights.
Yeah. So I run 2 businesses. One is called Bianco Research, which is an investment advisory firm. We write research for a living, mainly towards institutional investors. BiancoResearch.com is where you can find out more about us. I'm also active on social media under the Bianco Research title, on X Twitter under Bianco Research as my YouTube channel, and under my name, Jim Bianco, on LinkedIn. We have a second business. We manage a fixed income total return index. I'm a bond guy at heart. So we manage an index, an actively managed index, where we set the parameters of duration and curve and how much credit do we own and everything else. You can find out about that at BiancoAdvisors.com. And our partners at Wisdom Tree have an ETF that tracks our index. WTBN, Wisdom Tree Bianco Nancy, is the Nancy, just N was the last letter of it, is the ticker symbol for the ETF that tracks our index. So BiancoAdvisors.com is where you find out about our index, and WTBN tracks our index. You can find out more about it by looking up that ticker symbol.
Excellent. And I'll make sure to post all those links in the notes for this show. Jim, thank you again, my friend. I hope to have you back on with us in the future. This was entertaining and informative. So thanks for sharing your points of view.
Okay, I'll still be a mediocre manager by then because I won't have died.
Stay alive. We need more episodes.
Yeah, exactly. All right.
Thanks, Jim.
Thank you. Bye-bye.